Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. We are back with Paul Galloway for another coffee break session. Welcome back to the show, Paul.
Thanks for having me again, John.
Yeah, no problem. Could you jump right in and tell us what is a credit agreement?
Credit agreement is a legally binding agreement typically made between a lender and a borrower. There's no other way to say it. The borrower may use all or some of the amount of the credit that's extended, at least what's allowed within the agreement. So it's a pretty simple, straightforward type of agreement that's used by a lot of organizations to ensure that they have access to liquidity or capital when a need arises.
Okay. And what kind of terms are usually negotiated?
Typically, the amount of credit that is to be extended, the cost associated with it. So they'll specifically state what that is. Typically, that is some type of benchmark rate. In today's environment in the U.S., it would be a SOFR for like a floating rate, or a treasury note or treasury bill rate could be used as the base rate plus a spread. The spread is tied to the credit worthiness of the borrower. So that could vary depending on the borrower itself. The parties involved. Sometimes with credit agreements, depending on the type of agreement that you're putting in place, you could have multiple parties involved, meaning you could have multiple lenders for a single borrower. A lot of times credit agreements will be between one-to-one, but don't have to be. Terms of the agreement are specifically spelled out, when principal interest is to be paid, when the credit agreement expires. The other piece is, and this is really important, conditions and covenants. And this is something that organizations from a compliance standpoint need to monitor, make sure that they're adhering to what the covenants say. These are the typical terms that you would see within the agreement. Of course, there's always the standard legal language associated with these types of agreements, but the ones that I mentioned are the ones that treasurers typically care about.
Okay. You mentioned credit agreements usually going between one-to-one, but sometimes they're between two or more lenders. When does that usually happen, and what are the benefits or drawbacks?
Organizations might put together a credit facility or a revolver. Typically what you do in those instances is you have a lead bank that will extend the largest amount of credit to the borrower, and you have other banks that will come on board. And that can be driven by a variety of things, but typically it's around the relationship between the banks and the borrower itself. You might have, in your revolver or your credit facility, you could have 5, 6, 7 banks tied to the extension of that credit. Getting that consortium of banks together to put one of these agreements in place typically is beneficial on both sides. So think of, as a treasurer, managing share of wallet. Part of share of wallet is you have a number of banks that participate in the credit agreement. What this also does, though, is it also allows the borrower to get more in terms of the amount of credit that's extended. So banks are willing to do so much from their balance sheet in terms of extending credit to get to a level that an organization wants or needs at times. They would need to take this kind of route where they've got more than one bank that's part of the agreement.
Okay, so that would be useful if you are kind of at the top of what they're comfortable lending you.
Yeah.
Okay. Do you want to go into what are covenants? How do they relate to credit agreements?
Yeah, so, I kind of talked about this just briefly, but covenants are an important aspect to any of these credit agreements. And, it's the kinds of things that the lender wants in place to help protect themselves in the event that the borrower does something or doesn't do something that would be disadvantageous to the agreement itself or the amount of money that's being extended or lent to the borrower. There are positive, I'll just put it in these terms, positive covenants and negative covenants. Positive covenants require the borrower to act or do something. So it might be maintaining certain financial ratios, putting out certain financial disclosure, timely payment of principal and interest. These are things that require the company, the borrower, to do something. Then there are negative covenants. This prevents parties from doing something. So the lender doesn't want the borrower doing something because it may be disadvantageous to the credit that they've extended to that particular entity. Could be something around dividend payments, restricting management fees. So sometimes there are within organizations, there are management fees between different legal entities within a company. So a company could be, you got a holding company, you've got a variety of other companies that are underneath there that do different things for the organizations, products, services, where they do business. It could be global, it could be whatever. Sometimes they act on behalf of other companies and they receive management fees for doing this work. They can restrict those management fees in terms of how much is paid out in management fees. There could be a limitation on the amount of debt the company is able to take. In terms of my capital management, managing capital, I got to take this into consideration. I put into place a credit facility under a credit agreement that we've been talking about. How much does that restrict the amount of debt that I'm allowed to take based on that covenant? Non-compliance with either of these positive or negative covenants can result in a penalty. And so it's something that you don't want to have happen. That's something you have to disclose. That's something a rating agency would see. Covenants are put in place to protect the lender.
Okay, so the non-compliance would play back into the episode we did 2 weeks ago about capital management and really affect how you can be effective with that.
Yeah, absolutely. Your cost of capital could go up. Your ratings could get dinged. It's something that you don't want to have happen. Adherence to covenants is really important. So monitoring those as treasurer, you need to have something in place to do that. If you're not doing it, you should be doing it. Just make sure you're paying attention to those covenants. They are important.
Gotcha. Well, anything else you want to leave with the listeners for this week?
Just make sure that you're adhering to what you're supposed to do or not supposed to do. I think you'll be in good shape. The use of credit agreements is pretty common by companies. Just make sure you understand your terms, what your covenants are, and put something in place to monitor.
Well, thank you. And to our listeners, make sure you tune back in every first and third Thursday of the month for another coffee break session.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.